In this segment of our presentation, we're looking at the third method that the parent can choose in keeping track of their investment in subsidiary. So we're looking at, again, Chapter 3, Consolidation Subsequent to Date of Acquisition on Fundamentals of Advanced Accounting. So again, we're concentrating on the partial equity method. Previous presentations looked at the equity method and also at the initial value method. So you might want to take a look at those first before we get into the partial equity method. So we have our consolidation entries, just a review of what's different between a partial equity method and the equity method. We mentioned in previous presentations that the main difference will be the amortization. So we have amortization that we are going to report on our investment in sub-account, or the parent company will report in their investment in sub-account, or the equity income in subsidiary account on the income statement, but it will not include amortization. So for consolidation entries purposes, and remember that neither the parent nor the sub books these consolidation entries in their financial records. This is done off financial records, only on the parent side for consolidation purposes. Okay, so none of these entities, parent or sub, books these entries in their financial statements, in their individual financial statements. And so we have entry S, which is going to be the same as the equity method, and is to eliminate the subsidiaries and stockholders' equity. We have entry A, which is to adjust the subs' book values of assets and liabilities to fair market values on date of acquisition, minus any accumulated depreciation or amortization if we're looking at subsequent years. And then we have our entry I, which, as we said, is going to be the amount will be different than the equity method because it will not have that amortization. So it might be higher for equity earnings and sub, and slightly higher for the investment account as well. Entry D will be the same. That was to eliminate the subsidiary dividends. And then entry E is to record the amortization expense or depreciation expense. So we have a breakdown of the investment. We were looking at this example, parent company and son company. And if you go back to previous presentations, we have more details on the acquisition price, which was $800,000. The entity was purchased on January 1st, 2017. We have some companies reported net income, dividends, and the amortization that was computed. The breakdown of this amortization calculation is included in previous presentations as well. And so if we look at the equity method, we looked at the initial value method in the previous presentation, but here we're concentrating on the partial equity method. And we're looking at retained earnings of parent company. This net amount, the net income less the amortization for the 3 years from 2017 through 2019 has rolled over to retained earnings. So we're looking at beginning retained earnings, and then so we have the income, okay, accumulated income for those 3 years. We have the accumulated amortization for those 3 years. So technically, the parent should have retained earnings related to this investment of $309,000, beginning retained earnings as of 2020. However, since we use the partial equity method, we lack the amortization. So under partial equity method, our retained earnings is overstated. So we have to do an adjusted entry on consolidation basis to kind of decrease our retained earnings to mirror the equity method. And so in this case, the decrease will tie to the accumulated amortization / depreciation of 21,000. So when we go to the next slide, we have our equity in subsidiary earnings of 160. Note that under the equity method was 153 because we subtracted amortization, but we're not doing this under the partial equity method. Okay. Also note that there will be differences under the investment in Sun Company because we did not report that 21,000 of accumulated amortization in previous years from 2017 to through 2019. So we don't have that here either. So that will be the difference between equity method and partial equity method. And then we have, once again, our entry S. And entry S is to eliminate some companies' equity. So the same as we've done with the equity method. We have our entry A, which was to adjust Sun Company's book values to fair market value. We went over how we calculated the 91,000 in previous slides. This was the difference between the patented technology book value and fair market value as of date of acquisition, less any accumulated amortization. The same thing with the equipment, so you want to refer back to that. And then we have also to record once again this goodwill. So that's for entry A. So we go to our entry I. So like we said, the amount is different, but the entry is the same. We have a debit to equity and subsidiary earnings. We have a credit to the investment in Sun Company account, this time for 160. And then we have the decrease in retained earnings from using the partial equity method to adjust to the equity method. So in this case, we're decreasing retained earnings. Under the initial value method, we were increasing it. Here, we're decreasing it. So we call this entry C, and we debited 21,000 to beginning retained earnings, and then we credit our investment in Sun Company. So let's not forget the dividends. We have our dividends here that we have eliminated, and then that payable and receivable is also eliminated. So at the end of the day, we end up with a zero balance under consolidation totals for equity and subsidiary earnings. We end up with the same amount for beginning retained earnings, regardless of what method we used. So you want to go back to those consolidation totals. Don't take my word for it. Check this amount under initial value method. Check this amount under equity method, and you'll see that should be exactly the same. And then we have the same amount for investment in Sun Company. And once again, our equity section on the balance sheet should be the same as our parent company's equity. Okay. So that is the partial equity method.